Hi, I'm Jeremy Hutzel, president of Seven Springs Wealth Group. I'm joined today by our Chief Investment Officer, Andy Michael. It's July 10th, 2025, and we wanted to kick off the third quarter with a market update. Those of you that have followed along with us since the beginning of the year will remember our video back in January of 2025, where we introduced some key themes coming into the year. And the crux of that was this so-called Goldilocks scenario, a 2-2-4 economy. And I'm excited to have Andy here today to update us on how that's played out as the year has progressed. And we're now 6 months through a new administration. Andy, what are we seeing today?
Great question, Jeremy. And, we keep asking this about the 2-2-4 economy. What could sustain or derail it? And so the first thing we wanted to do going through the first half of the year is just check our temperature and see how we've actually been performing. And, I think this is something that's not really talked about a whole lot in the market news. But the reality is that 2-2-4 economy is in place. We're seeing it with GDP in the second quarter at about 2.5% is the estimate. Still, we'll have final numbers coming out later. Inflation is down to 2.4%, near 4-year lows. And the unemployment rate is at 4.1% through June. And so that is that healthy 2-2-4 economy that we've been talking about, that underlying healthy economy. There's been a lot of noise, as we know, throughout this year, but the reality is the big picture economy does look to be quite healthy right now.
Well, you mentioned the noise, and from an investor standpoint, markets have certainly been interesting to say the least. We did have that tariff tantrum, if you will, back in April, and what a remarkable recovery since then. But the story isn't just to the U.S. So as you walk us through what's going on in the U.S., I think it's important, and if you'd also shed some light on the international story where we've seen a lot of strength in markets, kind of tailwinded by a declining dollar.
Yeah, I think it's been a very interesting market to say the least across the globe. But starting at the top here, we look at U.S. large cap stocks with the S&P 500 up 6% this year. We would, if you just woke up, fell asleep at the beginning of the year, woke up, you'd think, what a nice boring return. We know it's been anything but that this year. A lot of volatility to get to that destination. The one comment I would make is that it has been a much bigger broadening out story this year, making up that 6% return. It has not just been driven by what's been called the Mag 7 now for the past several years. In fact, as a whole, those names are underperforming the 493, the other 493 stocks in the S&P 500. So that broadening out has been a very healthy effect. We're seeing the small caps flag a little bit behind. We're starting to see some of that rotation in July. We'll see if that holds. To your point, though, it has been about the international story. We're seeing not only those better valuations in international, that's been there for a long time. The two things that have really changed are, one, the currency. We're actually seeing some dollar weakening relative to those other major international currencies like the euro and the yen. That is helping drive some of those returns that you're seeing in international stocks and emerging stocks. But you're also seeing a growth story. And I think that's a really important piece for investors to realize. You're looking at what's being projected now for 10% growth in earnings for international developed stocks and nearly 20% growth for projected earnings in emerging market stocks right now. So that you are seeing healthy growth with better valuations from some of those international stocks, and you're starting to see some serious performance as a result of that. And then if you just go down a little bit further into the bond index, U.S. investment grade bonds, 4% returns. Those are some of the best returns that we have seen in investment grade bonds really since the large interest rate hike of 2022. So you're really starting to see some of that diversification with those investment grade bonds, with those international stocks playing out in the first half of this year.
It's been an incredible story, really, just across the board. And, I think what a lot of investors are asking us over the last few months or few weeks has been the risks and the opportunities ahead. For example, we had this tariff tantrum that was very short-lived and the market recovered, but as soon as it reached new highs, all of a sudden tariffs were back in the news again, drawing the headlines and causing some softening in the market, at least in the last couple of days. Counter to that, we've had really incredible geopolitical situation. Um, in many ways, a lot of humanitarian costs. It's a travesty that I don't want to gloss over. But from an investment standpoint, had you said months ago there was going to be expanded war in the Middle East and the price of oil would be where it is today, many people wouldn't have guessed that. So as you look forward, given how crazy this last quarter's been, what are those opportunities and those risks that you see playing out for the rest of 2025?
Yeah, and of course, this is not an all-encompassing list, but I think these are just some of the top things that are not only on our minds, but really all of investors' minds right now. And you'll see both the risk and the wish list all both start with AI. We have certainly seen this being an AI-driven market. I think what is different this year, a couple of things. One, you're starting to actually see some of the implementation, early days, but you're starting to see some of the implementation start to pick up with the AI story, and you're starting to see some of those instances of some productivity coming along with it. With that, and this is one of the healthier parts of the market that we see, it's not just those early developers, the infrastructure players in the AI space, but you're actually starting to see some of those application layers increasing revenues, increasing utilization. And so that really goes into that productivity boom. You may hear the phrase Jevons paradox a lot, meaning the more the resources available, the more the resource is consumed. And so, when you make more efficient cars, you don't use less gasoline, you use more. When you make AI more efficient, more readily available resource, it actually increases the utilization of it. And so we're starting to see some of that on the wish list. Numbers 2 and 3, not going into the details of those today. The big theme there, though, as I mentioned, is clarity, right? The market likes to see a long line of visibility. And so we think we just got that now with the budget and tax bill just passed into law. Trade deals are still up in the air, which is why they're on both the wish list and the risk list. I think what's most important to the market is to have that sense of clarity so you know how to operate moving forward. Deregulation of the financial sector and Federal Reserve rate cuts. I'm going to pair those together as well, just to say that's an overall stimulus to the economy that can lead to greater lending, greater business creation, greater investment, greater consumption from both businesses and consumers. All of those are great tailwinds to think about in the market. On the flip side, the risk list, I put it on really both sides. We could see AI be an overhyped situation again. We've seen those along the way. I'm reminded of 3D printers, for example. There was a lot of investment hype about those over 15 years ago. Not a lot really materialized in the way of actual investment returns. So there's a risk of that certainly with AI or counterpoint. I've even been reading some about how AI could potentially over deliver and input material jobs at risk. And so we want to be cognizant that AI could either be an overhyped story or in fact could over deliver in ways that we're not even aware of today. Certainly the deficits have been in the news a lot. We've been talking about deficits, frankly, in this country for the last 25 years since we last had a surplus. So some of this to me is the question of when does the risk become material and impact materially to both interest rates, bonds, and then ultimately the stock market? Certainly, we're seeing some of the biggest deficit spending in a non-crisis era. So it is absolutely a risk that we want to be cognizant of, which can also lead to some of that resurging inflation. Tariffs play into a part of that. Deficit spending plays into a part of that. So always keeping an eye on inflation. We've seen what it can do back in 2022 to both interest rates and the market. Trade deals we talked about, and certainly aware that valuations across equities in general are relatively high right now. So I think it's fair to say that the market is at least fully valued at this point in time, not without a lot of exciting reasons why, but that is certainly a risk as we move forward.
When I look at that list and then hear you talk about it, Andy, there's just so much, so many different paths that the market could go from here. It sounds like that cautious optimism with a diversified approach for a range of possible outcomes just remains the best case forward or best.
Yeah, I think that's a great point, Jeremy. And it's funny. We've now flipped 3 times how we phrase our overall stance. In the first quarter leading into the year, we were optimistic but cautious. That was the right approach as we had this huge tariff, what we're calling a tariff tantrum in the second quarter, which pivoted us to being cautious but long-term optimistic. And boy, did that optimism come fast and furious in the second half of the second quarter, and now for the first couple of weeks in the third quarter. So that puts us back where we started. We're overall long-term optimistic, but want to take caution as there's still a lot of unanswered questions in the market, and we're trading at high valuations. So a lot of these points here are the same ones that we've been sharing throughout the year. I just really wanted to highlight a couple of the 4 words there that I've bolded and underlined. We think it's a very important time to focus on profitable businesses with reasonable valuations. We are starting to see a lot of those narratives start to take back over in the market, something that we haven't really seen since late 2021. I think, right now, a lot of stories are flying very, very high and fast. We've actually seen unprofitable businesses be a lot of the leaders in the market right now as investors are gripping on to some of those very exciting stories. So right now, we think it's important to be grounded with profitable businesses at reasonable valuations. And again, we really want to stay flexible and be ready to seize on new opportunities. We saw that happen, in April, and really did our best to try to take advantage of some of those for investors that were in that position. We just want to continue to have that flexibility to be able to capitalize on those opportunities as we see them. I think one of the things that we've seen both now through COVID and through 2025 with this tariff tantrum, markets can move very, very quickly. So we think it's very important to have the ability to be flexible and be ready when those opportunities to come around to be able to take advantage of them.
It's great help, Andy, to have your objectivity, and I would echo that for an advisor working with someone. I know personally it's so hard to disconnect the emotion of some of these concerns around, rapid technological advancement can be stress-inducing for a lot of us. And of course, you look at the fiscal deficits that you've mentioned multiple times here, and as a citizen and a father, it gives you a lot of great concern about the future. But what I hear in talking through this with you is just how can you not be excited about the potential of the technological revolution that's going underway? And I know we're experiencing a lot of that in cost efficiency and time saving here in our business as well, and that's expanded across the world right now. So again, thank you for providing this reasoned analysis and objectivity to all of you out there watching. Thanks for bearing with us, and we look forward to catching up with you on the next quarter.
Thanks, Jeremy.